For joining us for today's webinar, Liquidity in Focus, Timing, Trends, and Tactics for 2026. My name is Sean O'Brien, President of QuickRate, and I am pleased today to be joined by Melissa Wallace. Melissa is going to take us through the second half of the presentation today. A couple of reminders. One, you will receive an email tomorrow afternoon, more likely Friday morning, with a link to the recording as well as a copy of the slides that we're using today. To get things started, as always, we're just going to start with a few polling questions. Certainly appreciate if you can join in on answers. Just a few questions. We'll give 5 to be exact, but we'll launch the first one. And again, appreciate any consideration or participation. Just always curious what brought you here today. Examiner requirement, diversify funding sources, reduce local cannibalization, contingency funding, looking for a non-brokered source. So we'll just give this 30 to 45 seconds. Okay, that's great. Go ahead and share the results. Most common reasons: diversify funding sources and contingency funding. So appreciate the responses. We'll move on to the next question, just around deposit growth. Have your deposits grown this year? Just a simple yes or no for this one. Excuse me. Okay. Again, this one's encouraging. 78% of you have seen your deposits grow this year. 22% of you have not. So again, thank you for those responses. Next up, just deposit needs. Are you anticipating needing deposits over the next 12 months? Again, just a simple yes or no. Share these. 84% of you are anticipating needing deposits over the next 12 months. 16% not needing. And just 2 more. Do you currently use any tools that help you conduct digital marketing? Again, just a simple yes or no. Okay. Here, 63% of you are not using any tools to assist in that, and 37% of you are. So thank you. And now to our final polling question, just current deposit and marketing. Are the tools you use to manage your deposits and marketing satisfactory? Again, just a simple yes or no. Okay. All right, this one's pretty evenly split. Let's just give it a few more seconds here. Percent of you say yes, 44% no. So let me share those results. Again, thank you for indulging us with those polling questions. We will include these results in the email that contains the link to the recording and a copy of the slides. So again, thank you very much. All right, so as the polling question suggested, most of you have seen an increase in deposits. Overall, the growth has been modest. But fortunately, it's been in a situation where it hasn't really been too far outpaced by loan demand. So the pressure, any deposit pressures really haven't been felt too painfully for most banks so far this year. Relatively, they still kind of remain expensive to acquire. We still see banks now, utilizing and relying on CDs for growth, particularly as the front end of the curve starts to come down. And I think we pretty much across the board see deposit rates pretty competitive with other market rates as well. One of the things that I just makes me always pause. Again, I'm a director in a small community bank. We have challenges with deposits just like everyone else. Certainly utilize quick rate to supplement our funding, but are constantly trying to build our deposits in our local markets. But the list of things that continue to disintermediate us from deposits continues to grow. Again, I'm old enough to remember when brokerage accounts and brokerage activities as part of the bank being offered through the bank or just competitively we're just getting started, right? 40 years ago, Edward Jones, 50 years ago, right? They situated and planted their brokerage offices based on where bank deposits were, because that was their way in to customers. Those continue to again just be sources of disintermediation. More recently, we see fintechs offering high yield accounts. Certainly, Apple, PayPal, Venmo, Zelle, again, all some that we now have to offer through our bank channels. But just again, more things pulling away at those core deposits that really used to be just kind of the domain of community banks. Gift cards continue to peel. And now, again, you add another one, online gambling accounts. How many young, particularly men, have money just sitting now in an online gambling account? So, all of those things make the challenge to go out and find and locate deposits increasingly difficult. You layer on lower personal savings rates. That loan growth has remained strong for most of us in the industry. Again, further putting pressure on it, and now pending legislation regarding stablecoin issuance, which again I think will be another drain on deposits. Right, some banks may benefit from those kind of coming back to them in a custodial account or some form or fashion, but I can see again the stablecoin issuance pulling away again at just some of our traditional core deposits. So the difficulty and the challenges in generating deposits has always been there, but again, the list of things that continue to kind of pile up against us remains pretty lengthy. And again, I think why it's hard to ever really feel great about your liquidity, right? If you're particularly trying to continue to grow loans, just because there's so many things that are constantly tugging at your deposit base. I think backdrop that with an economic environment where this kind of persistent inflation has left consumers with just fewer or less surplus funds. An economy that seems to be slowing, not completely clear, but I think any kind of uncertainty like that leads both businesses and borrowers or consumers to rather utilize any available cash first because they don't want to necessarily borrow any money. You add on to that as the unemployment rate goes up, and granted, we are at again remain at kind of historical lows for unemployment. But as unemployment goes up, deposits are usually going to go down. And so, again, the backdrop is challenging as we move into next year. In addition, increasingly, it feels like for many, depending on the markets that you play in, right? If you're a small bank like where I'm a director, it's a little bit of a zero-sum game, right? We're really in one or two counties, and so a lot of our deposit growth, or vice versa, is coming at the expense of another institution in our area, right? Where we may see deposit growth, we're more than likely probably pulling that from one of our competitors. And so going forward, right, we've always had to really work hard in our local markets. We'll have to continue to do that. And, and our gains will really be reliant upon, what our marketing budgets are, kind of what our branch system looks like. Speaking to our customers in a digital way, right? Do we have digital marketing channels that we can reach out to them? And then just the continued hard work of our branch staffs, right? It's gonna remain difficult to grow those deposits organically. And that's, again, that kind of gets it why, liquidity is just challenging, right? I think the thing I always remind, and I say this, and is just you have it till you don't. And again, I think it's increasingly harder to feel good about our liquidity. We do everything we can, but it does remain kind of a challenge. So one of the things that is again communicating and staying close to our best customers. Establishing attrition monitors so we know who has money, who's money that's might have left. Understanding that single relation accounts that many that we have, we should know how many of those we have, how much of a concentration or amount that they comprise. We should be understand. Size matters, but I think it speaks to the fact that we need better information around our deposit accounts, right? We really need to better understand kind of how our customer list is put together, clearly recognizing the top balance customers, but just really understanding kind of what our mix is and where potentially opportunities to grow might exist. Obviously we're continuing to speak to our customers, but again, I think building that information source with our own systems to be able to again both target customers specifically and or identify customers we might be willing to not overpay for their business. Again, better information is going to lend itself to better results and just again hopefully a stronger and kind of a stable deposit base. So I think as we touched on last quarter, and I'll do it again here today, right? I think sometimes we've built good policies and procedures, but it's imperative to have those because we might be flush with cash today, we want to be prepared for any adverse scenarios or situations that could impact us, right? So just understanding daily, where we like to keep cash or where we want our daily cash to be, understanding and optimizing our collateral, and again, just not restricting ourselves when it comes to policies in terms of how much wholesale funding we'll allow ourselves to have. Again, you want to make sure when times are good, you update or change policies rather than when trouble hits, because that's going to catch the eye of the regulator that you were behind the ball. So refresh, look at those percentages, make sure they match or can meet what you might need going forward, and update those rates and percentages while liquidity is good. And so again, part of that is being prepared for potential outflows as rates start to drop, right? Again, back to the disintermediation. As rates start to fall, again, more money might move to the stock market, right? Or to crypto, or just other things that again people feel might give them a better return. It might be any number of things. So you just want to make sure we're optimizing our available wholesale funding sources. Pricing deposits again is increasingly more difficult. We want to understand not only rate sensitive depositors, our best customers, rewarding stability maybe over just the amount. So again, understanding what the relationship is with the borrower, or excuse me, the depositor, is important to know. Obviously, we got to continue to monitor our competitors, take advantage if we can, tiered and relationship pricing. Certainly, some accounts will want to actively price those rate sensitive ones, and certainly a little bit more passive pricing for those traditional core deposits. So again, I think just all of this speaks to the fact of just being more proactive, less reactive, because again, it is a fluid situation with our liquidity increasingly, but making sure we size up what we have, how we're going to measure, how we feel about our liquidity, how we're going to react to adverse scenarios. Again, all building those things that we then incorporate into our contingency funding plan to make sure, should anything happen or adversely impact us, everyone knows how to react. And I think, again, while liquidity is challenging, the other thing I haven't even discussed yet or layered in is if we start to have any credit issues right now. So hopefully we won't. Past dues have certainly gone up this year across the industry. We've really not seen that manifest itself in any increase in charge-offs for most institutions. But if unemployment does continue to tick up, that some of us might start to encounter some challenges. And so the liquidity situation always changes once credit issues start to happen. So again, just be mindful of all the things that we can be doing while liquidity is actually relatively good. And so again, part of being prepared is just trying to understand what could adversely impact your liquidity, incorporating that into our policies and procedures, making sure we're reviewing concentrations and limits, and then stress testing and contingency funding, right? Making sure our contingency funding plan's up to date. Also articulating or just discussing things that might cause stress, right? Sometimes we jump to kind of the catastrophic stress events, but it can simply be, and as we're doing our strategic planning, and what some of you may be thinking about it, going back to the polling questions, is just looking at budgeting out or forecasting what loan growth might be and forecasting out what deposit growth might be, and there might be that shortfall, and figuring out, okay, how are we going to to deal with that. And again, we typically do that in a little bit of a vacuum, not in considering credit issues, right? And so that's often one that could just kind of sneak up on us, is we're managing our liquidity, but then all of a sudden you layer in credit issues, and now all of a sudden things can get a lot more potentially difficult. So again, how much cash is enough, right? Mindful of our daily amounts, but just also mindful of month and quarter ends. As the interest rates have the front end's coming down, that's helping anybody who has unrealized losses in their securities portfolio. So hopefully, our portfolio, that particular portfolio, is available to us. Hopefully, there's a fair amount of it that's unencumbered. That if we do need to sell those, we can touch on to those. But if we are, encumbering those, then again, we're taking one of our tools out of our arsenal, and now we're already on to other wholesale funding sources, right? So understanding that, managing that, and articulating that so everyone knows is important. I think, again, we've talked about this before, optimizing our collateral, right? Utilizing both the FHLB and the FRB. The Fed does allow us to potentially pledge additional types of collateral, more so than the home loan bank. But I think they recognize their role. I think they've got it. I don't want to say greatly, but they've certainly got a little bit more accommodative on allowing banks to have lines out there a little bit longer than they traditionally did in the past. But just understanding how quickly and timing of draws is important. Making sure we're updating our collateral so we know that it's not going to be have any risk of being denied as collateral. Doing internal audits. Obviously, the FHLB and the Fed are going to audit the collateral, but being ahead of that so there's no surprises should they do an audit is important for you to do kind of on an internal audit basis as well. And then finally, once we've kind of exhausted the options on our balance sheet, right, then we're on to multiple funding sources, right? Increasingly, I know human nature oftentimes is just to kind of gravitate to just one source or maybe two, but really increasingly today, we really need all options on the table. So obviously we believe we're great a great resource for supplemental and contingency funding, but also just for ongoing funding. We have to look at reciprocal deposits, public funds, and broker deposits. So again, making sure our policies allow for that, making sure our policies are updated for the percentages that we can utilize on all these, and then also updating our policies to make sure we've identified how much we're going to use for ongoing funding versus contingency funding. And part of that, once you've built those relationships, it's also confirming capacity, testing them, making sure we're maintaining relationships with those providers, and again, identifying if anything that could ultimately impact or negative or adversely impact your ability to use any of those funds. So again, understanding where our capital ratios are, and to make sure brokers are available to us. But again, just reviewing those, understanding those, being current with those are all kind of fundamental tenets of good liquidity management practices. And then it gets to stress tests. Again, I think in the past, we've spent a lot of time talking about stress testing. Again, it can mean a lot of different things. I think a lot of times the natural inclination is to jump to a very catastrophic thing, but I think increasingly, it's really just understanding where our funding or potential liquidity gaps might occur and how long they could be, and being able to just think about those, and again, make sure we have all the resources available to us to tap into if we need to, and that everybody on the team kind of understands where our liquidity is, where it could be, and what we would do if it got to a situation that was adversely impactful to us. Some of these, again, contingency events can just be something as simple as looking at next year's budget and realize we have a shortfall, right? The deposit gap, right? Where if we want to meet our loan demand numbers and loan growth numbers, do we have the funding, either organically with deposits or through wholesale funding sources to meet that, right? And if we have to tap into wholesale sources, what does that do to our overall liquidity then, right? So thinking about that, just replacing funding, unexpected withdrawals, right? We haven't really touched on too much, but those uninsured deposits, obviously are the top of mind still for the regulators. But part of response to those uninsured deposits is making sure you have wholesale funding sources that can address that. So again, we don't want to start pledging or thinking we have plenty of wholesale funding available when there's a lot of different instances where that money can get pulled just in our day-to-day operations, right? Just meeting our budget. An unexpected deposit or uninsured deposit leaving. So our situation can change pretty dramatically. So it behooves us more than ever to make sure we have plenty of capacity available. Obviously, implied in all of that is we're continuing to work our local markets for deposits, but also recognizing then just declines in credit quality can just change the narrative on all of these things. So we've been fortunate as an industry really to be, almost over a decade now of really having any significant adverse credit situations. Again, as I touched on at the top, past dues have picked up this year, but charge-offs haven't. But again, I think it's just something we have to be mindful of as we plan our liquidity. And then, again, back to just the mechanics of our contingency funding plan. How quickly can funds be drawn? Are lines active? What are the terms? Again, just checking that, confirming that, testing all that is critical. So these are just some reminders of the proactive steps to consider, to implement. Again, we've kind of touched on a lot of these, but again, just a little quick reminder. And so finally, right, liquidity is and always will be critical to our well-being. I think liquidity, just even though we have more tools available to us, just increasingly for many institutions continues to be challenging. Even before any credit issues, the uninsured deposits, I just don't think is a story that's going to go away. There still are, remarkably, at most banks, right? There's still a large number of our deposits that are uninsured, so we have to be mindful of that, know who they are. staying in touch with them to make sure those deposits aren't leaving. Because again, those are easy ones for people to target, right? Those are going to be easy ones for our competitors to target. As we went back to zero-sum game, right? A lot of our deposit growth can be, really focused on, intra-bank, right? We're taking it from one of our competitors. So again, liquidity is going to remain a focus for us and the regulators. Building on our risk management is important. And we're going to keep working our local markets to grow deposits, but it is increasingly challenging. Okay, so part of the reason you're here today is, right, that organic growth is tough, and that's why there's quick rate. And at this point, I'm going to turn it over to Melissa to talk us through the second half of the presentation.
Thank you, Sean. And thank you everyone for attending today. And can you flip it? Let's see. Perfect. We'll take you through the quick rate marketplace. I'll switch over to a live version and take you through the marketplace. But before that, we'll touch on the fact that banks use us on both sides of the balance sheet. The quick rate marketplace is neat in the fact that what we do very simply is just bring the buyer and seller together directly in the market through quick rate. So banks like yourself have the ability to offer a rate or rates in our marketplace and work directly with other institutional investors, which will be other banks and credit unions primarily. They also have the ability, if they have excess liquidity, to do some investing. So it is nice in that they can use it on either side, just dependent upon their liquidity position. We are not a deposit broker. We do not get involved in the transactions. So we show you how to utilize quick rate in either issuing or investing in CDs. Banks use us as a way to diversify, as we saw today on the survey, and add to their contingency funding plan as well. So as Sean mentioned, they use it alongside of borrowings and brokered funding and reciprocal deposits. Our goal is never to take the place of anything you're using, just be used in conjunction with those other sources that you have in place. The goal for a lot of banks is just not over concentrating in any one specific source for funding. So just having a variety of funding sources available to you. All institutions are eligible to participate. Our only criteria is that you're FDIC insured. And it's also a way, banks will use it too, as a way to bring some quiet money in without running the risk of cannibalizing or repricing their existing deposit base if they are at risk to do that. So they're able to quietly bring in some funding, because your retail clients do not see the rate or rates that you have in the market, because it is strictly a closed institutional only marketplace. Okay. You can flip there. We have been serving community banks all across the country of all sizes since 1986. We do have, as far as our activity in the marketplace, we have longevity in our client base. We've seen a 93% continued renewal rate, and 94% of our banks do rate their experience with us as at either a 9 or a 10 on our surveys. So pretty consistent there in our subscriber base. Perfect. We've also been recognized by the ICBA as a preferred service provider since 2002, something we're very proud of. And as we've continued to develop additional products for banks, they've taken those under their umbrella as well. And a couple of those are now IntelliCredit and then Quick Analytics, which are two of our additional products that we do offer to community banks across the country. And now what I'm going to do is share my screen here.
Okay, you can see it.
Perfect. So what I've done here is logged in live to the Quick Rate Marketplace. And when you subscribe to Quick Rate, you can have as many users at your bank have access to our marketplace. They'll have their own unique login and password to access Quick Rate. When you log in, you'll have access to your dashboard to see what, if any, investments or deposits you have are maturing, because again, you can use it on either side. any rates that you might have in the marketplace for CDs. We also give you the ability to offer callable CDs within Quick Rate. And then inquiries are communication. Everything is automated. It, again, as a closed institutional only market, everything is automated. It's very simplistic. So I'll step you through that process as well. But this just gives you a view at your dashboard when you initially log into Quick Rate. The first area that we're going to go through here is our view rates screen. This is where the investors focus. I'll show you how to post rates in the marketplace next so that you appear out here to the investors that subscribe to Quick Rate. But most banks want to see the market. So we'll look at how the investors use it so you get that understanding as well, what information they see on your bank, and then how they communicate and work directly with you. I have it expanded here to show you all of the standard rate terms that you can offer rates in. Outside of that, you have the ability to offer a term type and rate outside of the standard. The investors that are using Quick Rate, again, banks and credit unions, are typically staying within the insured limit. So it does require them to have access to a large pool of financial institutions, which is why not just the top rate at any term would obtain a deposit, because they're taking their portfolio, they're breaking it up into pieces just below the insured limit, and they're just going to be moving down the list to the next institution that they've not already invested with. Again, most of them are staying just under the 250 limit. So as they're using Quick Rate, their investments will be tracked for them. So to the left of the bank name, you'll see a blue check mark. This will let the investor know at a glance an institution that they're working with versus one that they're not working with by way of a pencil. Now, the good news for you when you are looking to offer rates in the market is the fact that you don't have to be the highest rate or rates to attract deposits because of the way the investors use Quick Rate in securing deposit insurance. So a lot of it will depend upon, and we talk strategy with you, how much you need, how quickly you're looking to generate the funding. Do you need funding quickly, or do you have time to start out lower, pay less for the deposit, bring them in slower? So some of them use, there's a strategy behind it. Some of them have a preference. They like to go out into the top of the market. So you're always in control with Quick Rate when you offer rates in the market as to how much you bring in and how quickly you generate the funding out here. So the investor will go to the next institution in line and they'll select the bank name. And this is the information that they will see displayed on your institution. They're going to get your general information. Everything for the investor will always be tracked via your FDIC insurance number. And then you're going to just provide very basic information to them as far as your minimum and maximum deposit amount, your frequency and compound type, your payment method, how you wish to pay that, any remarks you may want to offer to the institution. Below that will be your wire instructions. Included within that will be your in and out cutoff time and Eastern time, along with any fees affiliated with the wire. And most banks on Quick Rate don't charge wire fees because, again, this is an institutional market, so you're not working with consumers out here in the marketplace. There is not a settlement period on Quick Rate either. So when you're working or have a rate or rates posted in the market, you're communicating back and forth with the investor very quickly so that they can meet your wire cutoff time and have all of these settle same day. So same day settlement is always the goal when you are funding within Quick Rate. Below that will be financials that we obtain from the call quarterly. So we will provide financials on your institution. On the far right, you'll see what we identify as a QR rank, and that just simply mimics the FDIC capital rating of 1 being a well-capitalized bank through 4. As I mentioned earlier, there aren't any criteria that you have to meet to be able to work within Quick Rate outside of the fact that you're FDIC insured. At the very bottom, we have a history area where we'll have you activate a history alert, and this will just notify you in the event that a change occurs in status to an institution that your bank is specifically working with. So here's a couple name changers. Of course, today a lot of M&A activity, insurance number changes, but these are the typical types of changes that we see with our institutions. So you will get notified if a change occurs in status to an institution that you're working with. Now, the investor has reviewed the information, and what they will then do is select the pencil. Oh, I'm sorry. Let me go back here. They will not do that. They will select the rate that you're posting in the marketplace and add it to what we call their rate cart at the top here. Now, As I mentioned, they're going to move down the list to the next available bank. So in this scenario, if the investor were going to place $1 million or 4 CDs at 1 year right now, they're going to move down. They're going to start at bank 2, but they're going to move down to bank 10, 11, and 12. So they're going to skip these institutions here because they've already invested with them and they're staying within that insured limit. And so when they're ready, they're going to go ahead and access their rate card. And they'll key in the amount that they would like to place with each institution and go ahead and set that amount. And they can adjust it. This example, they're just doing up to 100. So maybe they want to remove that. So it'll flag them if it's if there's a, if it falls on a holiday or a weekend, they may make changes, but all of this will get communicated over to you. But they're going to go ahead and select these institutions and they'll send the inquiry. Now you only see when you are that bank that is posting the rate that you're receiving that notification individually. So you're going to get an email notification once the inquiry is sent from the investor over to your bank. Once you receive that notification via email, there'll be a link. You're going to log into Quick Rate, and it's going to take you into an inquiries page, and it'll take you to the appropriate type of inquiry that you've received. And I'll show you some information here as to what it would look like. So this would be having received multiple new inquiries. So when you receive an inquiry, you log in, you select the investing institution, and you have access to their information. You'll see the amount that they want to invest with you. The rate is always the rate you've posted on Quick Rate. That is what they receive. And then the investor's information along with their signers, their payment information, their tax ID number, and also their documentation satisfying CIP. Because you're working with financial institutions, you're not dealing with consumers and BSA and all of the consumer regulations. So CIP is minimized. When you do receive an inquiry from a bank or credit union, accompanying that will be their W-9 along with their signed corporate resolution. And in that resolution, we ask not only that they provide you with signers, but also sample signatures to satisfy your need for requiring a separate signature card, just keeping the process paperless and very simplistic, but satisfying CIP when working with that institutional investor. So you'll review that information. And then you'll go ahead and reply back to the investor, whether you accept or decline. When you're working with Quick Rate, you're never obligated to take in any more than you want or need. So you're always going to reply back to that investing institution. We ask that you do that, and generally you do that very quickly so that if you have to decline for whatever reason, they've got time to go back out and submit another inquiry and have that settle same day. So as soon as you accept, they're notified of your acceptance via a notification. They'll log in and access your wire instructions, and they'll go ahead and get that wire processed over to your institution. Once you've received the wire and you've booked it into your core system, you're going to generate a certificate or an account number tied to that investing institution. And once you've done that, you'll go ahead and key that in, tied to that investor. And then you will click one link that will not only post it to both your deposit as well as their investment portfolio, but it will automatically generate the safekeeping receipt and incorporate that into the portfolios as well. And this is a standard of our safekeeping receipt, which is a merged document. We'll embed your bank logo, and then it just merges in your information along with the investor information, of course, the terms, the standards here, your rate, your paid and compound type. We do have you customize this to include your withdrawal penalties covering all terms, and then stating upon maturity whether or not the CD auto renews. Being a merged document, it can be added to, but this is the standard that most will use. And then this is how it will appear in the portfolio, looking here at a sample investment portfolio. So if this is your bank, you've made the receipt available. It also appears in your deposit portfolio. It is a PDF link, and it does live electronically within this record as well. And this closes the loop on the transaction. So you offer a rate, the investor communicates electronically, you log in and respond. Upon the acceptance, they wire the funds. You book it into your core, generate the number, and then make available the deposit receipt. And again, that closes the loop on the transaction. So a lot of banks look at it as their virtual branch. Instead of walking in the door, you're coming to them electronically. And then of course, CIP is minimized, and it's generally, again, coming in in increments just under 250. So that's the process of how the transaction takes place. Now what I'd like to do is flip over and show you under the published rates area, how do you post a rate or rates in the marketplace? We do have some activity graphs that we give you because we don't get involved in the transaction, every transaction. We just track marketplace activity as a whole. We do this on a monthly or a weekly basis. So as the month ticks on, you'll see any of the previous 4 weeks, but you can select any term and look at what took place during that period of time. I'm gonna look at new. You can also take it and look at new inquiries as well as rolled inquiries. So here in this information, which is live information. So the first of every month we update it for the previous month. So October activity, any bank that posted a rate within the top 10 rate positions at the 1-year term, the month of October, took in just over 136 million, and they paid an average rate of a 4.04% for the deposit. 42.27 transacted at rates that fell position-wise, not percentile, 11 through 25 in the market at an average rate of a 397, and then just almost 11.5 here at 26 through 50, and then just over 5 million at a rate position below 51. So obviously on the new side, investors are going to the highest rate of a bank that they've not already invested with because they are staying with that insured limit and just moving down the list to the next available bank. And we have investors that have hundreds of CDs in their portfolio. So if you aren't actively funding or you're just wanting to bring deposits in very slowly, again, pay less for them. As you can see, there is activity that's transacting below the top portion of the marketplace. So a lot of it just depends on, what you're looking for at the time and how quickly you need to generate funding. And then if you're not actively funding, we do have banks that'll do some bottom fishing and put some low rates out there in the hopes that they'll receive an inquiry for a less expensive deposit. So you've got that capability. So you're always in control of what you bring in and how quickly you bring in the funding through Quick Rate. I do like to point this out. And these are the rolled CDs. This is what rolled over at 1 year last month. I think this is important because, Quick Rate itself can be lumped into the wholesale funding category, which can be looked at as volatile. So a lot of banks like to know that there is stability in the deposits that you bring in through Quick Rate. And not only is there stability, but you don't have to pay the highest rates as you would, or rates as high as you may have to when you're attracting new funding. So the most that transacted were a rate position that fell 26 through 50 at an average rate of a 399 last month at 1 year rolled over. So it is nice because it is a very stable funding source. So if you are looking to retain deposits, once those start coming up for maturity, and you can set maturity alerts to notify your investors in advance of the CD coming up for renewal, so that if you do want to make rollover rates available for them, you can at that time, or just request that they provide you with a wire request. But that is something it's food for thought, and it's out there. And I think it's good to note that if you're looking to retain the deposit, not only can you do that, but you can do that at rates below the highest rates being offered within the marketplace. So flipping back over to published rates. So you can post a rate at one or multiple terms, or you can use market positioning. A lot of our banks like market positioning because they do want to benchmark amongst the other rates that are being offered in the market, so they aren't paying any more than they need to for the deposit at that time. Again, the goal is getting what you need within the time frame that you need it. And so what we give you the ability to do by term is view what is currently being offered at the time that you select this feature. The top rate that's being offered at the specific term, the 10th rate position as it falls, so 10 rates down, the average of those top 10 rates being offered, the 25th, and so on. And on the far right-hand side, we'll let you know the number of banks that are currently posting rates at each of those specific terms in the market right now. And so most banks get a feel, we're going to plug in a ranker position that you want to start in, and most banks get a feel very quickly for where they're comfortable starting position-wise when they do offer a rate or rates in the market on Quick Rate. So I'm going to go ahead and just plug in a couple of positions here.
Melissa, while you're doing that as well, we did have a question come in, which is kind of
sure.
probably appropriate here. In what circumstances do financial institutions not take the top rate? Is insurance the driver?
Insurance is the driver, yes.
Yeah.
So,
Yeah, go
go
ahead.
ahead. So yes, because the investors are typically only going to invest once with you. So if they're invested with that top rate already, they're going to move down the list. And that list looks different all the time because banks are coming in and out of the market all throughout the day as their funding needs change. So yeah, if there's a top rate out there and the investor hasn't invested with them already, they'll definitely jump on that. But they're going to the highest rate of a bank that they've not already invested with, and then going down the list to the next available institution.
Yeah, thank you. And I was just going to say, I would add to that, right, that's part of the uniqueness is that some of these banks and credit unions have very large portfolios. So they are looking further down the list because they already hold a CD with some of these higher rates.
Exactly. So I'll plug in a few. So let's say you want to start, I'm going to throw in a position of maybe like the 15th position at 90 day, maybe the 20th here. I'm going to put in the 25th, and you can post callable CDs too, but I'm not doing that right now. I'm just doing regular CDs here. So let's say you're comfortable, and doesn't have to be the same position at every term. It could be a different position. It could be the same one. It's whatever you're comfortable with. And then you're going to set that position. And this tool is neat because it does the guesswork for you. So it comes back and it provides you with a rate that you would want to post, placing yourself so here's the rate, placing yourself at or as close to that position that you asked to be. The goal is to keep you from being tied with a large number of other banks. So it breaks yourself out of any pack of tied institutions. 2 or 3 others is fine. But it's strategic in placing you at or as close to that position, keeping you from being tied. Now, you can change the rate. I'm going to come back here. 8.5. And then reanalyze it, 1 or more of them. You don't have to. Here's a great example. So right now, and this is live data. So right now, there are 14 banks paying a 3.85. So at a 3.851, which is what the positioning put you at, it put you at 21. And so you've moved yourself above a pack of tied institutions, in this case, 14 other banks. You've really paid nothing more for the deposit, but it can make a significant impact on the response that you receive. Because in theory, it doesn't matter how many banks are below you. All that matters is how many banks are above you, and is that investor getting to you within the time frame you need them to. The beauty of Quick Rate is the fact that no matter where you position yourself or post your rates in the marketplace, you've always got, again, control to come in and out, bump your rate up, push it down if you're getting too much activity or not enough activity. So you're always, again, in control of funding you're bringing in through this market. So you're never stuck or, for your rates for any set period of time. So once you've gotten your rate or rates to where you'd like them to be, you can offer these a couple of different ways. You can just set a holding limitation or a date range limitation and just control it by inquiries received, accepting, declining. And then when you're done, you go out and remove or lower your rate in the market, which is very simple. Or you have the ability to set a holding limitation. You could do a per rate term limitation if you wanted to. I won't do this for each one, but if you wanted to set a dollar limitation, for each, whatever the amount is for each bucket. And then once you've done that, you can select your action. What do you want the system to do? Do you want it to send an email to let you know that you received inquiries totaling that amount? Do you want it to remove that specific rate from the market? Or maybe you want to, keep that rate out there, or maybe lower it just a little bit, or maybe do some bottom fishing and lower it quite substantially. So again, you're going to set this up however you like. We try to give you a multitude of different ways in which to do that. And then as soon as you post rates, they're immediately out into the marketplace. So they go immediately out into Quick Rate. And again, once you've got rates out there, you would log in and go to publish rates. And then you have the ability to edit rates by market position. And where I'm in now, I can't, but it'll say remove rates from market. So you can remove your rates as well from the marketplace at any time. So again, we try to make things very simple. You do have the ability to set CD rates, which would be for new funding you're looking to bring in. Then we also give you a tab which looks which looks exactly the same for you to post your rollover rates. Again, these rates are independent from the rates that you would post in the market for new deposits. They're only seen by your investor within a 3-day maturity window. And again, they may look very different from what you would have to post for new funding as well. And if you're not looking to offer rollover rates, you can request a wire request from your investors during that maturity window as well, and have that provided to them. So when they go out to their rollover area, they can see your institution and whether, what your status is, whether you have rates available or you've requested the wire request. The functionality is the same. They select the term, they send the inquiry, you accept, decline, post it, and create the receipt. The only difference is, of course, the money stays with you. So on the renewal. So the whole rollover side is all fully automated and very simple as well. Are there any other questions right now, Sean, so far?
No, that's it so far.
We do have a rate survey out here, which is a snapshot of the entire market. It is a dated and timestamped document. It changes throughout the day as banks are coming in and out of the market for funding. But we do give you the ability to generate it in a PDF format if you're wanting to take a look at that in comparison to other markets, or just for the sole fact of positioning what is currently being offered at the positions that you go out in, and what would you look to have to pay for funding at one or multiple terms in the market currently based on what's being offered out there. We do have reports that you can generate. You're booking these into your core, so you're getting everything you need from there. But a lot of banks will use a canned report or create a custom exportable report just to cross-reference their internal system. So you have that capability as well. We do also have a number of tools available to our subscribers. I'll just touch on this one briefly because as I mentioned, banks will use it as well to bring quiet money in without running the risk of cannibalizing or repricing their existing deposit base. Naturally, you're doing that anyways. As your clients are coming up for renewal, you're offering what you need to retain that deposit if that's what you're looking to do at that time. So this is just a calculator where they can come in and plug in some numbers and see some of the figures. So let's say you've got $5 million sitting in money market and savings accounts. Maybe you're paying a 1% blended rate. Let's change this to 10. Maybe you're looking for a couple $1 million in new CDs, and I don't know, maybe offering a 4.25% rate, maybe CD rate. And then go ahead and calculate. And this will look different because based on where you are in the country and in your marketplace. But you can fill in this calculator with different figures and then calculate based on a percentage of conversion. So let's say only 10%. Let's say your customers aren't very aware right now, and you convert only 10% of your existing deposits that you have sitting in money market and savings accounts, which are those that are generally at risk to reprice or move if a promotion is attractive. What does the effective rate then become? In this example, it will become a 5.88%, taking into consideration what you were paying on that deposit and what you're now paying on that deposit, and then the cost to convert those dollars, which does not take into consideration any advertising fees. So it can be very costly if you are in a position where you're at risk to reprice. And then still I'll have customers say to me that, we still didn't get what we needed and we still had to go out of area for funding. So it's kind of all the balancing game. And again, our goal is never to take the place. This is a very important, obviously your retail market, very important to you. Just again, used as a way to, a supplemental way to add to your funding plan and diversify your funding options. So that's just one example of a tool that we have built in and available for you. We do have a number of resources here for you. Regulatory information is just one briefly. We've here accumulated and provide you pretty much anything we're asked for. We make available to you as a PDF document. Debbie's our Director of Reg and Compliance. She's been at Quick Rate, I would say close to the 40 years that we've been around almost. And she's here to help with anything you need. I know Sean mentioned, early on being prepared. One of the things we do provide you with is a workbook, risk management workbook, and sample liquidity policy templates to help you put your policies and procedures in place pertaining specifically to your funding activities within this market. So that is something that we do provide our subscribers just to make it easy for you to get those plugged in, so you're not having to create or write policy. So that is something that we, again, anything we can do to make the usage of this market as simple as we can, we've attempted to do. And then the last little area here is just the profile area. We give you the ability to manage all of your information. As I mentioned, you can have as many users accessing Quick Rate within the institution, and you can set different roles and levels of authorization for those users. So on the funding side, maybe you don't want everybody having access to the published rates area to post, remove, or change rates. So you can, exclude that area of the program for them. Maybe they just want to go out and pull down documents on CIP documents or whatever the situation is. You've got the ability to control that information, and your different notifications, your maturity alerts to notify you, your history alerts, and then just your basic information is what we gather from you. So we gather your rate details and your wire details, along with your, CD investment contacts. So we gather very little information on your institution. And this is what we require up front from you. We have a setup form that we have you complete and provide back to us so we can populate this area. We go through training with you. And so, a subscription to Quick Rate is unlimited funding and investing. We go through training. So your support and training is unlimited as well. So that is, part of making sure everything is set up and running, and that you're comfortable with the entire process. So we try to make that very easy for you. And then investor information is just your basics here. And because you'd have unlimited access to funding and investing, you may start funding, and then down the road, you may want to do some investing. So you just let us know, and we get you set up and get you trained on that side as well. So we do make everything very simple. And that's what I have. Did any other questions come in, Sean?
No.
Okay.
I think
Perfect. And I will say, I know Sean's going to close out here in a moment, but, if any of you outside of this are interested in just a one-on-one, a demo through Zoom or conversation, I'm happy to log on and talk more specifically about your institution. We are here, and how we may be helpful, and then go over subscription pricing, which is based on asset size as well. If that's something that you guys are interested in, we're more than happy to talk with you and go over that with you as well. Well, perfect.
all
Thank
right.
you. I'm going to turn it back
Yep.
over to Tom.
Thank you so much, Melissa. Again, as Melissa said, we're certainly available to do a one-on-one. If there's any additional questions, go ahead and submit those now. Just a reminder, besides the CD marketplace, we have a suite of services available through our quick analytics platform. So certainly encourage you to look into that if you haven't already. Same way with IntelliCredit, third-party loan review solutions, as well as a portfolio analytical solution. So very excited about both of these offerings. Again, if you'd like to learn more, please let us know. Let's see. Question did come in. Oh, thank you. Glad to hear that. Appreciate the comment, Stanley. And let's see, continuing on. If there's,
I don't see your screen, Sean, if you're not.
Oh, you don't?
No, I don't see your screen. I'm sorry. Maybe others do, but I don't. Okay, there you go.
Got it now?
Yes.
All right. All right,
Okay.
sir. Perfect. Okay, and then just coming up Friday, we have another coffee talk. So Paul Allen from Saltmarsh, one of our dear friends, is going to join Steve Huntington and myself. So if you haven't registered, certainly please do for that. Again, if you register for any of the webinars, you will always receive a copy of the slides and a link to the recording. On the 18th, David Ruffin, Dan Marks, and myself will present the Q3 results from Quick Analytic from the QCBI. So again, encourage you to register for that. And then on the 19th, we'll actually have Jennifer Manning from Presidential Bank. Jennifer's a client of ours, and she's going to join Steve Huntington and myself to discuss how she uses Quick Analytics at her bank. So we think an exciting slate of upcoming webinars that we certainly encourage you to register for. Okay, so I think I don't see any additional questions. One final reminder, again, if you'd like to learn more, certainly reach out to us, schedule a demo on your own at quickrate.com. Reach out to Melissa, Pam, or any of our team members. We can talk and walk you through your bank situation, certainly give you a one-on-one demo, discuss pricing if it's appropriate, and certainly answer any other questions that you might have after today's discussion. So thank you again for making time out of your busy day to join us. We always appreciate it. We'll look forward to seeing you on our next marketplace webinar or any of the ones hosted by Quick Analytics or Quick Rate. And appreciate your time today. Thanks so much. Have a
Thank
great day.
you. Take care.